Hello, everybody, and welcome to Toku's earnings call for the first half of 2026. My name is May. I'm the Senior Vice President of Customer Experience at Toku, and I will be your moderator for today. A note on the format before we begin, this webcast is being brought to you live, and at any point in time, if you have any questions, just submit them. And we are going to go through a presentation for you, and after that, we are going to take and answer some of your questions live. After the session has been concluded, all of the materials will be uploaded on our investor relations site. Now, let me introduce you to the Toku members that we have here today, starting off with our CEO and founder, Thomas Laboule, who's going to walk us through the company's strategy, progress, and outlook. Good morning, Thomas.
Good morning, May.
And of course, we have our Chief Financial Officer, Christian Wong, who's going to walk us through the first half of 2026 financial results. Good morning, Christian.
Good morning, May.
Now, on to the presentation. On to you, Thomas.
Thank you, May.
This is our first half-year results presentation as a listed company, and we are glad to have you with us. Over the next 25 minutes or so, we will take you through our results for the 6 months ended 30th of June 2026. The momentum we are seeing across the business and our outlook for the second half of the year. Before we begin, please take note of the important notice on this slide. The financial information for the first half of 2026 is unaudited, and this presentation may contain forward-looking statements that involve assumptions, risks, and uncertainties. It should be read together with our results announcement released on SGXNet on the 27th of July 2026, which remains the source of truth. One housekeeping note: unless we state otherwise, all financial figures today are in US dollars. Our agenda follows the shape of the announcement. I will open with the key highlights of the period and how we delivered against the guidance we gave in March. Christian will then take you through the financial results in detail, from revenue through to the deployment of our IPO proceeds, and I will return to cover our commercial momentum and our growth engines in the Middle East and in artificial intelligence. Finally, Christian and I will close together with the outlook. Let me start with the headline. This was a period of re-acceleration, promises kept, and a balance sheet with no borrowings. The revenue grew 13% year-on-year to 18.8 million. That is more than double the 4.7% we recorded in the first half of last year, and it confirms the trajectory established in the second half of 2025. Just as importantly, the quality of growth improved. Subscriptions and licensing returned to double-digit growth of 10.4%, against just 0.6% for the whole of last year. Our gross profit grew 10.2%, with the margin at 23.9%, reflecting a deliberate mix shift that Christian will unpack shortly. The net loss of 3.8 million and the adjusted EBITDA loss of 2.9 million reflect a planned investment phase. The first-time costs of being a listed company and a front-loaded investment in our commercial engine. For context, the net loss was less than half the level of the second half of 2025. And the balance sheet transformation is now completed. Total equity stands at 11 million, restored from a deficit. Cash more than doubled to 4 million, and we carry no borrowings, none at all. In one sentence, we said at the IPO that we would transform this company's foundation, and in our first half as a listed company, we did. This slide matters to me personally, because trust with the market is built one kept promise at a time. At our full year 2025 results in March, we made a series of specific statements about what 2026 would look like. This slide reports each of them against what actually happened. We completed all 4 capital events on schedule. On the 13th of January, the convertible loans converted, eliminating 7.1 million in liability. On the 22nd of January, we listed on Catalyst and raised 16,250,000 Singapore dollars in gross proceeds. On the 28th of January, we repaid the shareholders' loans in full, and on the 9th of April, we repaid the Iris Venture debt facility early, retiring our highest cost borrowing and leaving the group entirely free of any borrowings. We guided a planned step up in costs. We anticipated a recovery in professional services and the stream returned to growth. We described our margin levers. Gross profit grew 10.2%. And the going concern uncertainty disclosed in our full year 2025 financial statements has been fully resolved. 5 statements made in March, 5 delivered by June. That is the standard we intend to hold ourselves to at every results announcement. With that, let me hand over to Christian to take you through the numbers. Christian.
Thank you, Thomas, and good morning, everyone. Let me begin with revenue. Total revenue for the period was 18.8 million, up 13% year on year. The context matters. Growth was 4.7% in the first half of 2025 and 13.9% in the second half. So this result confirms a sustained reacceleration rather than a single strong period. Looking at the streams, usage, our largest stream, grew 19.6% to 13.3 million and now represents 70.9% of total revenue, driven by higher enterprise messaging and voice volumes, including newly onboarded enterprise messaging customers. I will highlight the nature of this revenue. It is transactional in form, but reoccurring in nature, arising from continuing contractual relationships as customers route their day-to-day traffic through our platform. Subscriptions and licensing grew 10.4% to 3.1 million, back to double digits after 0.6% for FY 2025 as a whole. Professional services returned to growth at 1.2%, an early sign of recovery we anticipated in March, currently paced by the availability of certified implementation capacity, which we are addressing through recruitment and selective subcontracting. Maintenance and support declined 12.4% on the completion of certain legacy contracts, and together with hardware now represents just over 6% of total revenue. Taken together, usage and subscription and licensing made up 87.5% of total revenue, up from 84% a year ago. Gross profit grew 10.2% to 4.5 million. The gross margin was 23.9%, down 0.6 percentage points from 24.5%, and I want to be direct about what is happening here. The movement is entirely a consequence of mix. Usage carries a structurally lower gross margin than our software and services streams, and its share of revenue rose by 3.9 percentage points. The margin remains below the FY 2024 reference level of 27.4%, which is one of the 3 indicators the board has asked us to report on candidly, and we will do so at every results announcements. Our 4 margin levers are unchanged. AI-enhanced services on a consumption basis, partner-delivered services, proprietary technology replacing third-party components, and the progressive rebalancing towards subscription and licensing. While those levers take effect, we regard absolute gross profit growth, together with mix, as a fuller measure of revenue quality, and gross profit did grow 10.2% notwithstanding the mix shift. That also reverses the FY 2025 pattern when revenue grew while gross profit declined 3.1%. Turning to operating expenses now, reported operating expenses rose 46.6% to 8.1 million. This was a deliberate front-loaded investment period, and the step-up has 3 components. First, the recurring cost of operating as a listed company, sponsorship, listing and audit fees, and directors' fees, which we carry for the first time this year. Second, commercial capacity and talent. Senior commercial, product, and regional hires, including from direct competitors, and the build-out of our Middle East presence. Third, brand and marketing. We invested $500,000 in brand, public relations, and investor engagement against $40,000 in the same period last year. A substantial portion of that was one-off linked to the launch and the listing, and that is not expected to recur at the same level in the second half of the year. On an underlying basis, excluding listing-related fees this year and share-based payments last year, Operating expenses were 39.8% of revenue, up from 32.1%. The important message is this: the cost base now substantially reflects our full operating run rate as a listed company. The build-out is done. One note on comparability: first half 2026 also carries certain accruals for the recurring listed company cost and a progressive 13th month bonus accrual for which no equivalent charge existed in the first half of 2025 base. How does this translate to the bottom line? Reported EBITDA was a loss of 3.3 million. Adjusting for residual listing related professional fees of 600,000 and the MAS GEMS grant received in connection with the listing, the adjusted EBITDA loss was 2.9 million, a margin of minus 15.6%. The reported loss was 3.8 million. Two comparisons put that in context. Sequentially, it is less than half the 8.1 million loss of the second half of 2025, which carried the substantial listing related and non-cash charges. Year on year, the comparison is affected by a non-recurring 0.8 million of deferred tax credit in the prior year base. At the loss before tax level, the comparison is 3.8 million against 1.8 million. On an adjusted basis, the net loss was 3.4 million. That is the funded plan. IPO proceeds deployed into commercial capacity, brand, and regional expansion. Our break-even ambition is unchanged, and I will come back to it in our outlook. The balance sheet tells the story of a period. Total equity moved from a deficit of 4.9 million at 31st December 2025 to a positive 11 million as of 30th of June 2026. Total liabilities fell by more than 2/3, from 21.1 to 6.8 million, with a 7.1 million convertible liability eliminated on conversion and every borrowing repaid. Net current assets stands at 2.2 million against current liabilities of 10.3 million at year end. There are no borrowings and no assets pledged as security. The conditions that give rise to the going concern disclosure in our FY 2025 financial statements have been fully resolved. In short, a significantly strengthened balance sheet. Net asset per share stands at 1.93 US cents. On cash flow, cash and bank balances more than doubled to 4 million. Net cash used in operating activities was 4.8 million. That figure includes approximately 1.8 million of listing related payments, which includes the expense professional fees, the settlement of listing accruals carried at year end. Excluding those, the underlying operating outflow was 3 million, consistent with the investment phase I have described. Investment outflows of 1.2 million funded platform development, the fit out of our new office, and deferred consideration. Financing inflows of 8 million comprised the gross IPO proceeds of approximately 12.1 million, less the repayment of shareholders' loans and the IRIS facility. Finally, for me from now, the IPO proceeds of its 16.25 million raised, 10.2 million or 63% had been utilized as at the date of the announcement, with 6 million remaining. Utilization has been fully in line with the stated purposes as set out in our offer document and updated in the use of proceeds announcements of the 22nd of June. The undisbursed balance is held in interest-bearing bank accounts. One note on the early repayment of the IRIS facility. It retired interest of approximately $830 per day and is estimated to generate net savings in the order of $360,000 over the remaining term of the facility. This is proceeds working for shareholders. Let me hand back to Thomas now for the commercial and strategic picture. I will return shortly with the outlook. Thomas.
Thank you, Christian. As an enterprise platform in complex markets, our sales cycles typically span multiple quarters. So the revenue you have just heard reflects decisions customers made months ago. And the commercial activity of this first half tells you about the periods ahead. This is also the second of the 3 indicators we committed to report on candidly: pipeline conversion. And the story of this period is quality. The gross margin on new bookings reached 89% against 56% a year ago. One number I want to give you straight: is that the average deal size was 37% below the full year 2025 average. That base was actually lifted by the largest contract of FY 2025, closed in December. When we look against the first half of last year, so the comparable periods, average deal size was 18% lower on an unadjusted basis, reflecting a single contract that was around 40% of that period's new business. The median deal size rose 34%, and that is the more comparable metric. Our customer mix continued to shift towards higher value relationships. The number of Tier 1 customers, which are accounts above $500,000 in annual revenue, more than doubled in the period, driven by the deepening of existing customer relationships and expansion bookings from the installed base that rose 49% year-on-year. One thing to note, these deal values reflect contractually committed revenue, the same convention as our order book. So the margin on new bookings is not directly comparable to our blended gross margin. One theme runs through all of it: increasing complexity and multi-product opportunities, with growing demand for AI capabilities. Building on the first AI contracts we closed with enterprise and public sector customers in FY 2025. A note of discipline: these are leading indicators. They give visibility, they do not translate mechanically into near-term revenue. And one more number, a promise kept from our offer document. The order book stood at 29.3 million at the 30th of June, up 25% from the 23.44 million we disclosed in the offer document, measured on the same basis. Now to the Middle East, which we identified at the IPO as one of our principal growth levers. It is developing ahead of plan. Since our December 2025 announcement, we have extended our coverage from 2 markets to 8: Bahrain, Egypt, Iraq, Jordan, Kuwait, Oman, Qatar, and the United Arab Emirates. The Middle East revenue grew in the first half of the year, and our pipeline momentum has been stronger than we anticipated at listing. So why is the demand rising? Well, the regional conflict that began in February included direct strikes on commercial data center infrastructure. And the episode durably changed how enterprises and public sector bodies assess cloud concentration, data residency, and service resilience. Demand has been growing and is strongest among government and regulated institutions seeking locally deployable alternatives to concentrated cloud-hosted offerings. That is precisely the operating model we have proven elsewhere: locally hosted, compliant deployment. I want to be transparent with you. Our own regional deployment, then in its initial phase, was briefly affected in March. Our business continuity arrangements were activated, workloads were migrated, and services were restored with no material impact. If anything, the experience reinforced our differentiation, because our architecture deploys across commercial cloud, local data centers, and hybrid environments, independent of any single provider. We are establishing our in-country entity in the UAE to anchor the expansion, and in June we signed a memorandum of understanding with Sestec, a conversational AI provider, to collaborate on Arabic language AI capabilities for the region, with sovereign cloud partnerships progressing alongside to support the local deployment needs I have described. Let me bring that to life with one customer. Talabat, part of the Delivery Hero family, is one of the region's leading delivery platforms. We support Talabat across 8 markets, with more than 8,000 users handling inbound and outbound interactions, on a deployment that integrates our contact center with Talabat's own CRM and with Salesforce, served by in-house and BPO agents. The outcomes speak for themselves. Customer satisfaction rose to around 80% after voice was introduced beyond chat, a measured uplift of more than 20%. Faster, easier, more accessible service at regional scale. Our second growth engine is AI and the platform itself. And the theme of this period was moving from deployments towards monetization. On the 1st of July, just after period end, we launched Kawa, the first open source release of our Makamoto initiative. Kawa extends our position in AI infrastructure for customer experience and speaks directly to the sovereign deployment demand I have described. It signals our direction of travel. Toku is building the AI infrastructure layer for customer experience across our markets. AI transcription and summarization are live in production with enterprise and public sector customers in English and Spanish, with Mandarin scheduled to follow soon. This is the third of our three candid indicators, AI adoption, and it has moved from build to monetization. These services are live with enterprise and public sector customers and generating revenue today. And the second half of 2026 will be our first half with them running full periods, so we expect the contribution to grow progressively from here. Accounts where our AI suite is deployed have recorded an uplift in monthly recurring revenue of approximately 26% against their pre-deployment baseline. A framing note on that figure, it reflects an early cohort and the economics remain account-specific since each deployment differs in scope and contract structure. As coverage extends across our customer base, the average will move in either direction and clearer trends will emerge than this sample can show. We will continue to report principal indicators of AI monetization at each results announcement. Our global platform relationships continue as well. We serve Delivery Hero brands across 4 regions, Pedidos Ya in Latin America, Glovo in Europe, Talabat in the Middle East, and North Africa, as well as Foodpanda in Asia Pacific. Last but not least, our channel partner program is developing well, extending our reach without proportional headcount growth. The proof of what our platform can do sits here in Singapore with IRAS, the Inland Revenue Authority of Singapore. This was the first contact center deployed on Singapore's government commercial cloud, serving the entire taxpayer base, fully managed to government standard. This year, the IRAS helpline system won the Commissioner's Award for Service Delivery Excellence, recognition earned by IRAS on infrastructure we are proud to provide. The strategic value goes beyond one deployment. The blueprint we built with IRAS, combining government-grade security, elastic scale, and AI in active adoption with agents and supervisors, is a playbook we are now replicating with public sector institutions in other territories, including the UAE. Public trust, proven in one of the world's most demanding public sectors, travels well. For what all of this means for the second half of the year, back to you, Christian.
Thank you, Thomas. Let me translate that momentum into the commitments you should hold us to. This guidance was given in our announcement of 27th July. On revenue, we expect the year-on-year growth rate in the second half on an organic basis and before any contribution from inorganic opportunities to exceed the 13% recorded in the first half, consistent with our established seasonal second half weighting, and we expect subscription and licensing to sustain double-digit growth on conversion of a strengthened pipeline. On gross profit, continued growth in the second half. The first half demonstrated our ability to grow absolute gross profit through the mix transition. On cost, we expect reported operating expenses in the second half to be below the first half level, as listing-related fees and one-off portion of marketing fall away, subject to the pace of our Middle East investment. With revenue growing on a broadly stable organic cost base, we expect visible operating leverage to begin in the second half. Beyond the current year, we intend organic operating expenses growth to remain below organic revenue growth, so this leverage continues to build. Finally, no dividend has been declared for the period. The board is applying our resources to the growth strategy. Thomas.
Thank you, Christian. On the medium term, our ambition is unchanged. Progressive improvement towards adjusted EBITDA profitability over the next 2 to 3 years, built on operating leverage from an established cost base and a revenue mix rebalanced towards software and AI-enhanced services. With no borrowings, we are well positioned to participate in industry consolidation as an acquirer. Disciplined and criteria-led, with opportunities of scale funded through an appropriate combination of internal resources, debt, and equity, sized to the specific opportunity. As the annual report set out, the execution of our next acquisition remains one of our stated priorities. Let me close where I began. Why Toku? Because the growth engine is proven. 13% growth, re-acceleration delivered, and the Middle East ahead of expectations. Because the platform is AI first, live with government and enterprise, with Kawa now in the open. Because complex markets are our moat, 38 plus markets across 4 regions, regulatory expertise as a barrier to entry, and a playbook that travels. And because the path to profitability is visible, a cost base at run rate, a balance sheet with no borrowings, with 11 million of equity, and a 2 to 3 year ambition we have reaffirmed today. We said what we would do, and we did what we said. There is much more to build from here. Let's keep climbing. Thank you for joining us this morning, and thank you for your trust in Toku. Christian and I look forward to your questions.
Thank you, Thomas and Christian. Now, if you haven't submitted your questions yet, you still have time. We're going to run through the ones that we already have here today. And we are going to start with Christian. The first question is going to be, usage revenue increased 19.6% to 13.3 million. How much of this growth came from existing customers increasing activity versus newly onboarded customers?
Thanks, May. We've seen an increase. It's a mix from both existing customers as well as new customers. For example, for the new customers, new revenue is starting from Latin America, from Middle East, North Africa, and it's like some revenue that has just started in Europe as well, which will take us to higher revenue in second half of 2026.
Okay, thank you for that. On to the next question, and this one goes to Thomas. Management has consistently highlighted FY 2026 as an investment year, with greater benefits expected to emerge over time. Based on what management has seen during the first half of 2026, does it remain confident that FY 2027 will be the year in which these investments translate into more meaningful operating leverage and earnings improvement?
Yes, absolutely. I think that by now the market is also aware of the long sales and delivery cycles that we have. So that's why we are putting so much emphasis on the commercial indicators. We've done that at the previous earnings call, where already in the second half of 2025, we were seeing a good momentum on our pipeline, the conversion, and also the number of deals that we were closing. And this has continued in the first half of 2026. Actually, it has accelerated. So we see more opportunities, and we are very confident that this is going to accelerate and be reflected in the numbers in the periods ahead. So yes, high confidence.
Thank you. Thanks, Thomas. Next question is from Kevin Tan from The Edge Singapore. There we go. AI token costs are becoming a source of concern for businesses, and some have pared down their expenses on AI. Has that been a problem for Toku?
Short answer is no, and I think it plays also to our strategy, to the principles that we have for our value proposition, where we think that because there is also an expectation of commoditization in the AI field, that working only with third-party AI providers is not sustainable for the enterprise segment. And Toku has, since the beginning, been working with fine-tuned models that we are hosting ourselves. So we do not have any exposure to token costs, as we are directly hosting either locally or with hyperscalers, and therefore our cost is on the compute itself. Moreover, it's important as well to differentiate the high cost of tokens for powerful models that are constantly coming out, and there we have a few American and Chinese providers that are leading the field. But when it comes to the customer experience portion that we do, the outcomes do not need the biggest model possible. It's actually something that is very much fine-tuned in order to deliver cost efficiency and accuracy. So our core AI suite
is extremely cost efficient, and I think it's one of the reasons why it is also seeing such a great success in the adoption.
Okay, thank you. There's another question from Kevin Tan from The Edge Singapore. Was the rapid expansion of the Middle East driven by partnerships or acquisitions?
No acquisitions yet. It was mainly driven by first organic business development, and as we are mentioning in the announcement itself, the conflict has actually emphasized our value proposition in terms of being able to quickly move from one hosting provider to another, also accommodate public sovereign cloud, which is one of the things that they are now focusing on since the conflict has seen some deterioration and interruption of services with other data centers. So that is something that we have seen as one of the reasons for our pipeline momentum to be as strong as it is at the moment. And so we are seeing the Middle East still as one of our growth levers, as already announced in the offer document. And basically the conditions in that region has accelerated the momentum.
Okay. On to the next question. This is from Alfie Yo of RHB. Based on your earnings momentum, when do you think you can break even at net profit level? This is a question for Thomas.
So we are obviously balancing growth with the break-even point. The profitability goal is obviously a priority. But as we've seen, for example, that we got international expansion opportunities, it would have been foolish for us not to invest ahead of the curve and to basically develop new markets as we got the opportunity to do so. So I think that we will keep the guidance given in the announcement, where we are saying that on an organic level, adjusted EBITDA break-even is possible within 2-3 years. But of course, as we are running in parallel roll-up strategy pipeline, we see there also an opportunity to accelerate the break-even momentum.
Okay. On to the next question. It's still going to be to Thomas. What is your business projection in the Europe market?
So interestingly, Europe has become more complex as well. And I want to constantly refer to that because it is what we've been emphasizing since the beginning of Toku. So we are built for complex markets. And it's true that the fragmentation of the world, geopolitical tension, the more regulatory focus has actually increased that value proposition for us. And in the past, Europe was seen as a kind of uniform market where the regulations were the same across all member states. But lately, there also we see member states that are coming up with additional regulations on top of those provided by the EU, which again is making our value proposition where we have an architecture that can easily have a compliance at multiple levels without impeding the user and customer experience as one of our strengths. So Europe, as we've announced, we've already deployed successfully in 4 markets. We signed 18 markets more. So that is to come in the periods ahead, where we are progressively going to deploy in Europe. And similarly to MENA, we think that Europe is going to be one of our biggest growth opportunities in the periods ahead.
Thank you. The next question is going to go to Christian. Operating cash flow was 5.1 million, approximately 3.3 million excluding listing-related payments. How is management thinking about capital allocation over the next 12 to 24 months? And how would you balance between funding organic growth, pursuing strategic acquisitions, and maintaining the balance sheet flexibility?
Okay. So as we mentioned in the announcement, we expect at least for the second half of this year, we expect the revenue growth to be higher than our organic growth in operating expenses, right? So, but overall, we remain very cautious and careful on how we invest and spend every dollar and cents out there.
And maybe if I can chime in there, in terms of the strategic acquisitions, obviously we have a budget that is allocated to that as part of the IPO proceeds. But depending on the targets that we will have the opportunity to acquire, there could be additional funding required. And that's why we also focused on having a clean balance sheet and reimbursing all the borrowings that we had, so that basically all the options are on the table whenever an opportunity arises to have a mix of debt and equity funding if needed.
Okay. The next question is going to go to Thomas. How Toku has grown with their pool of existing customers in terms of usage revenue, be it increase in numbers of users through deeper penetration within an organization, customer growth, or order size via increase in usage through existing offerings or new offerings?
So, as Christian mentioned at the beginning of the Q&A session, it's a mix. But what is important to remember is that in customer experience overall, the number of interactions between customers and their respective brands is increasing, right? So it becomes easier to interact with the brands that you are using on a day-to-day, no matter the channel that you're using in terms of communication. Voice is still the leading part, especially for our business. But we see that there is a high increase. So it's the number of interactions that is increasing for most of the brands that we serve. And then additionally, part of the offering is also evolving, where you now have value-added services, typically AI-driven, that are also going to add additional usage revenue. Because for AI monetization, there is a mix between a subscription and licensing portion that gives you access to the AI services, and then, of course, the usage. So basically, the same minute of conversation, if we are sticking to voice, is suddenly no longer only going to be monetized through connectivity, but also through the AI service that is provided, which can be multiple, right? It's going to be the transcription, it's going to be the summarization, it's going to be the sentiment analysis, and then, of course, the insights that are provided through the conversation analytics overall. So obviously, usage is going to remain a big portion of our growth and of our revenue mix.
Thank you. The next question will still go to you. And it is, given the recent geopolitical conflicts in the Middle East, particularly concerns around data center infrastructure, has Toku experienced any service disruption to its operations or customer deployments in the region? Does Toku have meaningful customer or revenue exposure in the areas most affected by the conflict?
So, as we mentioned in the announcement, we were in the initial phase of our deployment in the Middle East. Actually, we had 2 countries live, as announced, I think, in December 2025, Bahrain and Qatar. And so we were also affected by the initial attacks during the beginning of the conflict on the data center infrastructure. Luckily for us is that we have, at that point in time, not a lot of activity going on, but also we have the necessary business continuity planning, and we have an architecture, as I said before, which is not linked to one single hosting provider. So for us to shift from one data center infrastructure to another is actually easier than for other companies and other enterprise software. And so to the second part of the question, we actually have seen that this value proposition is very attractive to the local customers that we are approaching, so existing customers, but also prospects, and especially in the public sector, where they want to ensure that they have more resilience and that they have more flexibility, and where also, like in Singapore with the IRAS example that was in the slides, the public sovereign cloud approach is something that the UAE is prioritizing.
Interesting. The next question is going to go to Christian. Adjusted EBITDA margin deteriorated from negative 7.2% to negative 15.6% as management continued investing in commercial capacity, product development, and regional expansion. Looking ahead, what are the key drivers that you expect will support a gradual improvement in profitability? Will the pace of losses start to moderate as these investments begin contributing more meaningfully to the revenue?
Sure. I think we've covered some of these just now under the earlier questions about the prospects, the profitability guidances, and so on. But more importantly, the looking at the adjusted margins, 7.2 to 15.6 losses, right? There are some fundamental reasons behind, right? In first half of 2026, we have additional costs relating to the listing fees. Also, as a listed company, we have additional professional fees, audit fees, directors' fees, sponsorship fees, and so on and so forth, which did not exist when we were a year ago when we were still just a private company, right? We've also invested significantly in terms of commercial, in terms of product development, right? In terms of headcount, right? We expect these costs to stabilize in the second half of 2026 going into 2027. Also in the first half of 2026, again, as mentioned in the announcement, we front-loaded quite a fair bit on the marketing and PR costs, right? Again, we don't expect this to recur going forward, and we always remain very cautious on how we spend every dollar. I keep repeating that, but it's very important for us.
We know.
And I think that on the regional expansion part, one thing to note as well is that some of these investments now are going to be leveraged with every new customer that is basically onboarding on the platform. If you take Europe as a guidance, we've already invested and deployed the architecture in order to serve all the markets that we have signed for. But at the moment, only 4 of them are live. And so as the other countries are also coming into production, we will see more revenue and more margin coming in without having additional increases in the operating expenses for that region.
Yep. Okay. On to the next question. This is going to go to Thomas. Is Uber buying Delivery Hero affecting your business?
Well, we are very excited actually about the transaction. It was a long time in the making. There was a lot of news. Obviously for us, the Delivery Hero brands represent a big part of our business, and we have been able to expand with them internationally quite a fair bit. And so now we see the acquisition by Uber as an additional opportunity for us to have new relationships and also see what we can do with Uber in the different markets that they serve. Of course, there is a very long timeline to the deal completion, so it's not going to be something that will happen immediately. In any case, for us, we do not expect or see any immediate impact on our business because we are dealing with the brands individually, as mentioned in the announcement, and also because we are very integrated, highly compliant with the local regulations, and so we see our business as extremely sticky. And overall, for us, it's an opportunity to create new relationships and see how we can grow with Uber in the future.
Sure. Okay. The next question is still going to go to you, Thomas. It is mentioned that AI adoption continued to build, but revenue contribution remains modest. How many customers are currently using paid AI capabilities? What uplift has been observed? And when could AI revenue become financially meaningful?
Well, that the AI adoption revenue is modest. We haven't been commenting on that breakdown. That's something that we are waiting to do in future announcements. Overall, we've been very satisfied with the pace of adoption since last year. We've not only onboarded private customers, but also public sector customers. The uplift, as you could see in the slide, is quite meaningful. Of course, we need to see how the trends evolve because every contract is slightly different. But at the moment, we see uplift of 26% on the deal value or the account value generation on a monthly recurrent revenue basis. So this is very promising. And again, it is for the usage revenue stream. It's for also the same transactions, the same interactions. So we see really the AI as a multiplier for us.
Okay. And I think that's about it for the time, everybody. Thank you so much for joining us today and for submitting your questions. If we have not gone through them, we are going to prepare written responses for you and publish them according to guidelines. A copy of this webcast, the financial results, as well as the presentation is going to be made available for you. It's going to be uploaded in our investor relations site. Now, we hope that today provided you with clarity on our performance. We hope that we convey the conviction of the team towards the company's success. On behalf of Thomas and Christian and the Toku team, thank you for your continued support. We will see you on the next one. You have a great day.